Happy New Year, everyone. Hopefully, everyone had a great holidays. In this video, I will talk about my 2021 predictions. These are the topics that we'll be going over today. Once again, I am no professional. These are just my personal opinions, not investment advice. Please do your own research. Next up, let's talk about the stock market. Again, the valuation is still decoupled. You can see by looking at the number of companies who are having increased share price, even though their earnings are still negative. So they're not making any progress, but people are still buying their stock. It's very momentum driven. Investors are still very optimistic. For example, like just I think it was Thursday or Friday, some people on CNBC, like some figurehead, were talking about that even though they know it's a bubble, but what can you do because it keeps going up? So there's a lot of momentum traders. Um, Next, for retail investors, a big participation through like fractional share ownership and a lot of these commission-free trading account like Robinhood. Many examples of non-professionals who have grew their platform. Like some people like have YouTube channels like or other platforms or even just Twitter by trading momentum stocks. There's one I forgot the name of that couple, but they were saying, oh, if I see a stock go up, I just buy it, and I make money. Like no, these investors have no knowledge of valuation and the business. They're just buying it because stocks go up, and obviously short term, um, you can outperform a professional, but my bet is in the long term, people who actually study valuation and cash flow, balance sheet, uh, obviously still income statement, that will come up on top. You know, Obviously the Fed's manipulation doesn't help that aspect, but we're starting to see like value stocks start to um, pick back up comparing to just mainly the tech and momentum stocks. So maybe we're seeing a slowly gradual shift. Next, insiders selling. So if you look at the insiders buy and sell ratio for the S&P 500, you can already see that the more sophisticated insiders are already getting out. They're not um, willing to chase these prices, so they're just dumping on the retail investors, probably taking on some leverage to push the prices higher, and a lot of derivatives. If we actually take a look at the options market, there's a bunch of examples of retail investors taking on massive leverage by using options trading to, chase a momentum stock, and that is one of the signs for a peak of speculative market. I do expect a correction. I think the quickest would be February to March, as mentioned as before, maybe February 10th. And latest, I do expect by Q3. I don't think it can be pushed much further unless the Fed really ramp up, which we'll talk about a little bit more once we talk about the bond market. So the bond market. So the long end yield continue to push up. I forgot to mention that a lot of these markets, I'm focusing on the US just because it's the largest one. I will go in detail for like other areas um, if I feel the need to mention. Um, Anyways, for the long end, it continues to push up. 10-year, it's past 1% as I predicted, and it should hit 1.5. But once it hits 1.5, where it gets close to, I think the Fed will have to come out because when it's much too high for in terms of the existing debt. And next for 30-year, it's pushing for 2, but once it passes 2, I think it has a potential to rapidly go to 3 to 4. Now the idea of yield curve control YCC, so ECB, Christine Lagarde has already pushed that out in terms of their implementation, and the Fed is most likely next based on the yields continue pushing. Now, I've mentioned before YCC doesn't work, but what it does is instead of doing amount, and when you do QE, like that's absolute amount, like how much you're printing, YCC, even though you're still like printing, um, like print QE to buy the bonds to push down yields, but you have a targeted um, uh, amount that you buy. So what happens is instead of doing quantity, you doing it based on price. And historically, it has shown that it reduces the speed and amount that you have to increase by, but we'll have to see. But regardless, it's still money printing. Finally, the reason why the central banks can't allow yields to rise is because there's too much debt, not just for government, but also for um, businesses and people. And if yields continue to push up, not only will those people have trouble with repayment, also for the investors who hold bonds, they will also see their assets being devalued. So, still more money printing. Now let's go over the currency market. Now the euro has seen a high of 1.23 euro per US dollar. I'm bearish on the euro versus the US dollar. This could be a potential trade as ECB wants a weaker euro and obviously lower yields. And euro makes up for a big chunk of the US dollar index. Um, so if the euro goes lower, the chance of US dollar index going higher is higher. So the DXY bottomed around $88. Again, long term, I do expect it to go down, but I think it has found a short-term bottom. And that the idea of the need of a stronger dollar from Biden and Yellen. And obviously, Yellen put that out because um, when you have stimulus checks, when you're printing out massive stimulus checks and giving it to people, you need to make sure that your dollar actually buys something. So there is a need of a stronger dollar, and obviously you still have the historic history of when it's a Democratic president, you do have a stronger dollar. But what they want and what the result will be obviously will be very different. So we'll see how strong they can keep the currency up while still having to do a lot of money printing. So perhaps maybe tapering a little near end of the year. Obviously, rates might not increase. Like I don't think rates are going up anytime soon from the Fed. But even just the idea of floating it out or just tapering QE amount of QE. So we'll see. Maybe they'll just increase liquidity, and increase velocity by increasing, maybe pushing the banks to lend out more, maybe stimulate that way, increase velocity that way instead of adding more money supply, just speeding up velocity. So we'll see. Finally, RMB, I think, will be the key for inflation in US mostly, but also maybe countries that have a trade deficit towards China. This will be discussed at the end of this video when we talk about China. Now let's talk about agriculture. So for the three that I talk about, for the most part, soybean, corn, and wheat has now made their 7-year high. I do expect all of them to continue to rally. However, I think soybean might have gotten ahead of itself a little bit, but I don't know how long this agriculture bull market can continue, like how long it would go for. But I think by the end of it, we could see 1500, even 1600. Corn maybe even 650, and wheat 800, 850. But I do think the upside is higher in corn and wheat comparing to soybean, just because the run it already has. Obviously, soybean builds into a lot of different products. Corn, it's not mainly used for eating, it's more for industrial, like corn oil for energy or just feeding for animals. Wheat would be a key one for um, a lot of you know, regular consumers, because it builds into it's important um, basis for starch. Now, again, weather is key. It looks like Russia has already increased the export taxes for its wheat. Uh, and when it comes to corn and soybean, we have Argentina and Brazil, two like main exporters, have already limit their exporting, and they even decreased import taxes. So they've already run out most of their storage, and they're realizing it, and they have to go after to actually import them. So as a regular export country, it's, you know, really odd for them to have to import. That's because they sold out a lot of their storage, and the next harvest time in March, we'll see the impact during the winter when there were a few weeks where there were no rain. So that definitely is a huge impact. So again, we'll have to see how the El Nino effect play out for the rest of the year. But I do expect the idea or the news food shortage is coming on the horizon. You know, this is not a trade that I'm happy with, but you know, I'm just trying to play the hand that I'm being dealt, and I think this is a possibility. Now that we've talked about a potential food shortage crisis, now let's talk about energy crisis. Now, oil, U.S. reduced production from Biden, as Biden, his platform, part of it was to reduce oil production in U.S. So U.S. will return from a net exporter to a net importer, and also OPEC Plus agreement to continue to cut to make sure prices push up. So I do think Brent has found a bottom, maybe around 48. So what that would be a key level to watch to make um, in terms of you know, stop loss. I do expect to see 80 bucks or even $100 barrel in 2021, and I do expect by the end of this oil bull market, we will hit a new all-time high for oil past 140. Now, something to note is, on top of reduction of supply around the world, the demand picture. Now, there is currently, I think, what, 1.2 billion people. This is a cool analogy by Rick Rule, where there's a lot of people under the poverty line across the world, and the idea is that they would like to live like first world country, and they have increasingly the ability to do so, where when first world country, what they buy is services. So if you look at US, like 70% is service and consumption. But if you look at a third world country, when what they buy is infrastructures, you know, energy grid. They go from, you know, no, like a fire stove, no energy, to like, you know, a electric heater. They go from, you know, having to walk for water, and now, like, you know, fresh water out of the tap. Like, so their type of consumption increase is much different than, you know, services. So I do see energy being a big part of it. Next, uranium. Uranium is very interesting. So we've already seen quite impressive run up for uranium stocks in the Q4 of 2020. Now, the reason why you don't really see a big increase, like you might wonder if you just look at the spot market, like, you know, it's still 30 bucks. Like, it makes no sense why uranium stocks have had a big run. Now, the reason for that is it's a very small market, and it's also very different, where um, the spot market doesn't display the futures market, where that's where the big supplier and meet the big customers. And one of the recent news is Chemical, so the giant in Canada, and Kazatomprom, they're refusing to sell unless the prices are established at meaningfully for their shareholders. So probably around $50. So we'll see how long it takes for the demand side to realize, okay, we can't do $30. Like these guys won't sell it to us. And because they make up such like base load energy, like for US, I think it was 13% of that base load energy is from uranium. So another analogy by Rick Rule is, do you think if you like wake up 5 years later from today and you go turn on the light, like is the light coming on? If it is, then uranium can't be priced below cost of its producers. Next up, let's talk about precious metals. Obviously, a big topic since this channel has been warning about inflation and the signs are showing, but it's kind of tricky. How come precious metals have not been performing? Now, the consolidation phase is continuing. Traders are selling precious metals as yields are rising because the idea is that holding precious metals makes sense if in a negative yielding environment, but as yields are rising, why am I holding a piece of gold that generates zero return when I can hold like a US treasury yielding like 10-year yielding what 1.1 right now per year? But the problem is they don't understand that the yields are rising because inflation expectation is rising. So you shouldn't look at the nominal yield, but rather the real yield. So as inflation pick up quicker, then the yields pick up because I do expect Fed to come in with more stimulus and also YCC capping yields. Then if yields are capped, but inflation picks up and exceeds it, then again, the negative real yields will continue to decrease, and that's very bullish for precious metals. Key levels to watch: gold need to break 1900 resistance, and silver needs to break 2650. Once we break those, then we could see a more meaningful rally. I do expect gold to go back above 2000, and silver maybe we can push for 30 or 35. So catalysts, again, there are more fiscal stimulus and monetary policies. It doesn't even have to be enacted. Even just the news might be enough to push the metals higher. But we can already see Biden coming in with all the executive orders and his push for another massive stimulus bill. Now, obviously, there is no money around. They're not collecting as much in taxes, so therefore, again, any fiscal policy enacted right now will have to be accompanied by monetary policy, so meaning more QE. The Fed has to buy it up. And again, inflation ramping up, so perhaps that will come from agriculture or even energy, as long as it's something that is more related to your average day citizen, then we would see inflation really ramp up. Finally, let's talk about what exactly is holding inflation back in the States in particular. So inflation at the mercy of China. So for inflation, there's usually three key factors. You need the first two, but you normally don't have like a really meaningful pickup until you get the third. So massive deficit or massive debts we already have, not only government deficit but also businesses and consumers. So why that is needed is because the inability to repay in today's dollar terms. So meaning I physically cannot repay the whole loan in today's dollar value. Either I have to default on the loan and the debtor and the lender negotiate maybe 80 cents on the dollar kind of thing, or you money print and inflate the you devalue the value of your currency. So yes, you still repay a dollar, but that dollar could not have bought you as much stuff as you inflated it before. And also the inability to let interest rate rise. Obviously, if you can't afford to pay the debt, the interest at these level. If interest rates go higher, then you have more trouble, and that leads to money printing, which is the next point. And especially with the records amount of currency creation, if you just look at the balance sheet expansion in for example, the Fed or ECB or even just Bank of Canada. Bank of Canada actually has a very impressive increase in terms of percentage-wise from 120 billion to right now I think over 500 billion. So very, very impressive. We'll see what that results to. Finally, the supply shortage. Now this is the key. Right now, China has picked up the supply shortage where when, for example, in the US where a lot of production facilities have shut down, and China has been able to pick up that supply shortage and continue to export to US, and that's why you've seen a lot the US trade deficit to China increase during the pandemic. And also you can see how well the businesses, the factories are doing in China. That's why they're able to restart much quicker and recover much quicker comparing to the rest of the world, is because they are able to continue production and export to the rest of the world. Now, one key factor, however, going forward is China's 5-year plan. So, the government in China is famous for their 5-year plans. And this one in particular, they're indicating their desire for a more self-sufficient economy. So meaning they want to be able to produce what they need. So the dual cycle. So buy locally and also sell locally. Now what that means is they will have to reduce both export and import from other countries. But with US country that is at a trade deficit to China, meaning they import more from China than they export to China, and how they've been able to export inflation to China by, instead of paying for the goods, they just sell them treasuries. That is very detrimental. So a few things China can really push for inflation in the US. Either, obviously, they've already decreased their treasury holdings. They can let the RMB rise, so that means it will increase the cost of importing for US, which means it will also increase prices. Another thing they can do is just reduce, like they can set like a cap saying like, oh, we need to sell this much within our country before we can export. So a lot of things that China can do, and I do expect the Bank of China and the government to continue to push for that. And once that happens, then I think that's it in terms of the US dollar's ability to hold back inflation. So again, China is the key right now. We'll see what their play is, but I do think they will come through in terms of US central bank like Powell wanting inflation.